Hey guys, it's Max Convexity. Welcome back to the channel. Tonight we're going to have a little options lesson. This is going to be some kind of advanced option stuff or intermediate option stuff. So if you aren't interested, no hard feelings. Probably about 50 or 75 people will watch this, but I hope those people get something out of it, or I know they will. I had a subscriber email me to do a NVDA earnings trade. NVIDIA has earnings next week, and I had a couple of suggestions. I'm going to suggest a trade, but then I'm going to suggest a strategy too. You'll see an overall strategy. Okay, so first of all, let's check this baby out. These are daily bars. Look at this freaking thing. My God, that's crazy, isn't it? Okay, so let's just for fun, let's just look at the last earnings. So right there, that was earnings. So that was the day earnings was announced. The day after it gapped up. Okay. But look, what I want you to notice is even the week going into earnings, it was up. Okay. Or this one gapped up after earnings, but it was not really up going into earnings. It actually pulled back right before earnings. Okay. That's fine. This one was up going into earnings, but then went sideways after earnings. This one was trending up into earnings, then went sideways after earnings. Let's see about this month. This month was definitely trending up into earnings, went sideways after, trending up into, sideways after. This one was trending down or trending sideways into and went down after. Although this one was in the middle of the 2022 bear market. That NVIDIA was under the 200-day average, which doesn't happen often. But as far as being over the 200-day average, which would be my definition of a bull market, or one definition you could probably use, would be a bull market. So the bull market earnings, okay, that one was trending down into earnings. This one was up into earnings, went up. The theme is here, it usually goes up into earnings, and then usually up afterwards. I mean, this is NVIDIA afterwards. Okay, so first I'm going to suggest, let's suggest this first. Let's do a double diagonal. This is a great way to do earnings trades, in my opinion. This is almost always some variation of what I select. Okay, so NVIDIA earnings are the 28th. So that's the week of the 30th. Okay. So that is the short leg. Double diagonal is where you sell a put and a call, otherwise known as a straddle or a strangle, depending on if the strike prices are together or apart. And then you also buy a put and a call in the week behind that, or some week behind that. All right. The reason we do that, I also brought up Tasty Trade. Here's the reason we do that. So right here, this is the different weeks and how many days they have left. So this week has 4 days left, right? Well, look over here. See this IVX, 57.3, okay? Next week is 88 because that's the week earnings is in. So volatility is unusually high in that week. Well, in the week behind that, it's only 78. So there's about a 10-point spread, right? Okay, remember that. But then in the months behind it, you know, like this one's 72 to 70, 70 to 66, 60 to 64, 64 to 62, 62, 61 and a half, 61 and a half, 59.75. It's more like a 2-point spread. So the reason this spread is so big between these weeks is because this one week right here, the week of the 30th, contains the earnings, right? All right, so what we're going to do is we're going to put on an option position that takes advantage of that. So I'm going to go back to option strat. So you can just go, you type NVIDIA up here. If you haven't used option strat, you hit build double diagonals, the lowest one on the right, okay? Then they'll just kind of set you up with one. You have to make sure the dates, you have to make sure the expiration or the earnings is in the week of the short options. That's the whole idea of this. So we have it set up like that. And I'll post a link to this trade afterwards. Okay, so here's what I usually do. This is my method. I usually move the strikes together. Still the same trade. You're selling two options to pay for two options. It's just a different variation on it. I don't even want to get into it right now, but okay, so what a trade like this does is it makes your loss limited to $157 if it goes down real big, $141 if it goes up real big, and you have a big area in the middle where it can be profitable. It just can't go up more than 13% or down more than 10%, right? Okay. Well, the problem with this is stocks usually go up. So what I usually do is a variation on this trade. So what I usually do is I usually do this. So I do some variation kind of like this. What I've essentially done is I'm pushing all the risk to one side. Okay. And I usually push that to the bearish side. All right. So the way you do, there's various ways to do that. I'm just going to share the trade. If anyone wants to know more, DM me and we'll talk. But anyway, so what a trade like this does is NVDA can go way up and go sideways. It can go up a little bit, down a little bit. It just can't go way down. This gives you a buffer of about, 6%. It can't fall under 121. If it does, that sucks, but you're going to lose $350 most likely. Because if it misses earnings, it'll probably go way under that. But there's a lot of occasions when it actually has earnings and doesn't move that much. You saw some of those on the chart. And you also saw some where it gapped up the next day. So we're covered. And there's all kinds of variations. If you're more bullish, you could do a trade more like this. You move this call further out. And that means you would make $278 if you had a big day, but you're risking 432 and you have 6 points of buffer. What I do is in option strat, I have specific metrics I look for. Like I say, get with me if you want more information on that. But I think that would make a fine trade right there. There's nothing wrong with that. $434 risk. You just can't let it drop under 121, but or 123 in this case, so you may not want to do that. I mean, there's no trade without risk, but where this trade pays for itself is because lots of times a stock will drop 5%, go up 5%, go down 2%, go up 3%. If it does any of those outcomes, and lots of times they go way up too. If it does any of those outcomes, we're looking pretty good. All right. So that's one thing I would suggest. So that is, let's just hit save trade and we'll follow that. And we'll just say pre-earnings trade. All right, now I have one suggestion, and this is just for the advanced option strategist, or not really, but all right. Here's what I really think. I think let's talk about a strategy. That trade's all right. Yeah. I like it all right. Pre-earnings trade. Okay, we got in there. I like it all right, but what about, let's go back to Tasty Trade, and I'm going to show you. All right, so here's what this IVX kind of means, or here's another way to interpret it. So it's just, you could equate it with the IV, implied volatility, or the VIX. You could equate it with the VIX of 57. Okay, but kind of more or less. See this plus minus 530? That means how many points the options have priced in to move in either direction. 5 points up, 5.3 up, 5.3 down. Okay, and that's because the IV is just 57. In the week behind that, the IV is freaking 88 and it's priced in a 14-point move. Options are cheap in this front week. And we haven't done anything with this front week, and it only has 4 days in it. Okay, let's look at one other thing, though. All right, let's look at one other thing. This freaking market's on fire, and this just gave us a bullish trending buy signal in this time frame. Yes, it could be a fake out. Sometimes you'll get, I found some fake outs. There's none right here, but right here, you had one that broke out and then it fell. I mean, yes, it happens. This one actually broke out in a failed, but this one was good. This one was good. You know, these were good. I mean, this thing's been on fire. I'm saying this thing probably runs up in earnings also. And that's why else I was showing you, you know, so this on this day, let's just say if this happens again, earnings are the 28th and it's 19th. Let's see, we're 8 days away from earnings. So 1, 2, 3, 4, 5, 6, 7, 8. So if we put this trade on last time, it ran from 89.56 to 93 prior to earnings, or close, actually 94.95 prior to earnings. Then the day after it opens at 102 or something. Okay, so this strategy that I'm suggesting would have worked perfect. So let's look at this. Let's do this trade. We don't want to spend too much. It's not even going to be a spread. This is how we're going to try to exploit the trending element. And we're also going to try to exploit the difference in IV between the weeks. So the other trade is our earnings trade. We can put that on now. That's fine. I'm suggesting this as an additional trade or part of a strategy. All right. So let me show you. This is just a straight buying calls. So this is actually a trade where you don't have a mathematical advantage in your favor. And I usually don't recommend these kinds of trades, but I'm going to show you why I do. So then two things. One thing is because it is in the week that is the low earnings or is the low IV. So I think we can get a reasonable price. The other thing is if it keeps trending up, look at the prior high. What's the prior high right there? What is that? 136. And then this high is 140.76. What do you bet they want a gun for the prior high prior to earnings? So I just bet they do. I bet they take that out. Even if it's a trap, I bet that it goes up there. Okay, so let's set a target of, let's set a target of 141. So here's what I want to do when I just want to buy a call. Okay, so this baby's going to go to 141. So if I want to make $500 on the trade, I need to buy, what's 141 less 5? 136. I need to buy a 136 option. So we'll put on the 136. All right. So there's the 136 option. Good news, it only costs $92. Okay. So I would just do this one and just add the win or the loss into the other trade. This one's going to expire on Friday. If you get a big move into Friday and it runs to 142 or 141 was my target, you make 410 because you make 500, which is the distance between where it is now and the strike price. Right? Is that right? Did I say that right? Well, no, yes. Okay. It's okay. 136 is 5 points away from your target is what I meant to say. Okay. So we're buying the 136 option. If we're aiming for 142, the option's going to be worth 142 less 136 at expiration, which, or we're actually aiming for 141 was my math. 141 less 136 is 5. So options are in 100 units of 100. So this option trade's worth $500 gross, but remember it costs $92. So we're going to call that, so we're going to net that out at whatever it nets out at. I already forgot what I said. But anyway, 141 right there. What's that, 407 or something, right? Okay. I used to be good at math in my head. But I really think that this trade, I think that you might do them together and, now I would size them accordingly too. I think they're fine the way they are. You risk, let's do it in separate windows. Okay. This one this one's a $435 debit. The other one's going to cost you $90. It might make money. It might lose money. If it loses money, hopefully you make at least $93 on this one. Okay. So let's see what has to happen to make at least $93 on this one to offset that other one. You've just taken your buffer down to 4.3 from 5.4. Not a huge deal, but it's something to consider. So you've taken your buffer down and guess what? You've added $93 to your total risk in the case of a bad miss and it goes the other way. So for every one of these trades I would maybe recommend one of the other ones. So, because some people, $400, $500 isn't enough risk, and that's cool. you go to option strat, you hit link legs, you hit that on link legs, and then you can up the units. Let me make sure it's doing that right. 222. Yeah, that's doing it right. So if that's not enough risk, you can, if 870 is enough risk, if you want to spend 1,300. So we'll do that one. So let's say a person is going to spend 1,300. Okay. Well, then let's size this one accordingly. So we're going to do, see, this is more, that's why I said it's kind of advanced. This isn't just showing you how to do a trade. You have to with options, you could try to solve a problem and an investing problem. And that's what we're looking at. We're looking at a problem of, well, I think it's going to run up into earnings. If it does, one might make it some extra money. And also the IV in this week is here, and the IV in this week is here, and the IV in the next week is back down here. What do we do to exploit it? So every earnings trade could be different. Next time on NVDA, this strategy may not work. You may use some variation of it. I'll tell you this much, that this strategy works a lot. This strategy is a tried and true earnings strategy, something like that. The double diagonal with skewed to one side. So you can, okay, watch this. You could do this if you're bearish. You could do the same thing. You pull the puts out of the money. It's the same thing. Okay, so you tell me which way it's going to go. We'll both make money. I have no idea which way it's going to go. I like to err on the side of bullish, especially in the bullish market, especially on NVIDIA. I don't remember exactly what strike that was. It 136? Yeah, it was. Let me see. Or let's just go to safe trades. It was a 137. Okay, there it is. It's back. But anyway, so size it unit for unit. If you do this 3 times, do 3 of those options. And I think you'll have good results. I really think we're going to run up. Hopefully, that $93 option will hopefully turn into $200 or something. Maybe even $400 or $500. If it does what I say, if it goes for the old high, which it might turn into $400 or $500. Okay. Well, then you have to, that option expires. You take your profit. Then you add $400 or $500 profit to this trade. So then all of a sudden you have a gigantic freaking buffer, because if you add $400 profit to this trade, it's almost free. If you could make $429 on the other one, this trade's almost free, where you have no risk in it. That's always what I'm looking for, is no risk. You heard me tell Jay in that interview that all I'm looking for is true. Is I'm looking for strategies where you can make an income, through time decay, because that's how you make income. But you, at the same time, you don't expose yourself to much risk, or preferably any risk, or as little as possible. But all right, guys, this is the way this is one way to do it. Like I say, hit me up in the DMs if we want to talk about it or something, and start small, or try it with one unit. With one unit, it would cost, what do we figure, $500 or something. Okay, do it on paper. There's still some earnings trades left in this season. Maybe do it on paper, and then in fall or winter, there's still 2 more earnings season coming up. There's one in October, and then there's one in December. September, October, kind of, and then one in December, January, kind of. So, that would be my suggestion. But like I say, I have no guarantee. I have no idea what this could do. Both trades could be huge losers. That $93 option could be a loser, and this thing could go straight the other way. So, you have to consider that. The only reason I like it isn't because I know which way it's going to go or have any freaking idea. It's just because it's math. It's just math. It just comes down to math. The expected value of the trade, in my opinion, is more than the risk, in the trade. Or I think the risk in the trade is commensurate with the expected value. All right, guys. Well, I hope you guys like that. Like I said, I would love to talk anyone on an individual basis. I don't check Discord too much anymore lately, try to hit me up on, but I'll try to start checking them more, but hit me up in these comments and I'm more likely to see it. All right, guys, I appreciate you. Have a good day.